Gold prices are about to explode and no one is mentally prepared for it. Everyone is prepared for a scenario where there are interest rate hikes, where the dollar will explode, and where gold will get more crushed down. But no one, literally no one, is prepared for the scenario where there are no interest rate hikes at well, and the story will completely change. For the past few months, a narrative was being built about interest rate hikes due to the elevated inflation and due to the elevated oil prices. But as of now, that story is completely changing and it can completely change the course of gold as well due to few things which have been happening beneath the surface. Let's uncover it and let's uncover how gold prices can explode in the coming few weeks. Market participants as of now are fully prepared for a 25 basis point hike by the end of the year, and that was mainly led by the hawkish FOMC by Kevin Walsh in the last month, and that obviously hurt the story for gold prices as well. But what was the main causes which led to a hawkish FOMC and for markets to eventually start pricing in a rate hike instead of a hold or instead of a rate cut? There were few things at that time. Rising oil due to the Middle East conflict, and obviously these rising oil prices were feeding directly into the inflation as well, causing the inflation to spike up. The CPI, the PPI, the PCE data, all of them were saying that inflation is totally back. Also, at that time, the labor market was strong, economy was performing very well. So the Fed had no reason to control or to hold the interest rates. The Fed had all the excuses after seeing the oil prices, after seeing the level of inflation, and after seeing a strong labor market that we can very well hike the interest rate. That is what led to elevated expectations of rate hikes, and that is what exactly led to rising pressure by sellers on gold prices as well. But what if that story completely changes right now? Now, gold is generally a non interest yielding asset. It does not yield any interest on your investment. So, if the inflation expectations are rising, if the expectations of interest rate are rising, then obviously gold will get hurt. The capital will flow out of this non interest yielding asset toward an asset which does yield interest, or it can be obviously the bonds. Now, when the narrative was running, which was saying that we may very well see going into the coming future that interest rates will rise, the capital started to flow out of gold, and for the past few months we have been seeing its reflection, the reflection of this macro picture in the gold prices. But right now some things have been happening beneath the surface which are now completely changing the story, which are completely changing the narrative that we will even see rate hikes. The narrative is now shifting from interest rate hikes towards possibly a hold in interest rates or maybe even rate cuts going into the future. And the capital is already positioning for that. We are already seeing gold is forming a bottom around this critical support area, around the psychological $4,000 levels, and looks like from a technical perspective as well that it is ready to explode. Now we will discuss the fundamental picture which is happening beneath the surface, which actually supports the story going into the coming few weeks. Now this shows you the inflation rate and these are the oil prices. Here is a simple correlation between the inflation rate and between the oil prices. Whenever the inflation is heading down, or you can say that whenever the oil prices are heading down, inflation heads down with that. And whenever the oil prices are rising, inflation rises with that. Why? Because inflation directly feeds into your food costs, into your energy costs. I'm sorry, inflation, oil directly feeds into your food costs, into your energy cost, into your transportation cost, and all of that stuff, which indirectly raises the prices of your food, of your energy, of your goods, of the services you receive, or of the services you give. It directly impacts the CPI, it directly impacts the PPI, and it directly impacts the PCE as well. Now, as we can see that it is very clear from this correlation or from this macro concept that whenever the oil prices are elevated, inflation rises with that. Whenever the oil prices are moving down, inflation moves down with that. Whenever, again, as we are seeing right now, with the Middle East conflict, as the oil prices started to spike up, inflation started to spike up with that as well. But we are going to get fresh inflation data next week. What it means, as you can see right now, that oil prices are already moving lower due to the MOU, due to the Memorandum of Understanding, due to the understanding, or due to the fact that the strait is opening up gradually, due to the fact that the supply of oil is gradually coming back. Market participants are pricing that in ahead of time, and it is leading to a decline in oil prices worldwide. But what this means? This simply means that due to the decline in oil prices, your transportation costs are declining, your food costs are declining, and your energy costs are declining as well, which eventually means that your inflation will now start to cool off as well. Your CPI data will cool off, your PPI data will cool off, and your PCE data will cool off as well. This is the one thing. Now, the second thing here which you need to look at is the headline NFP numbers. Earlier during the war months, the labor market was looking very strong with the unemployment rate looking steady, with the non-farm payroll numbers rising, with the job opening rising, and with initial jobless claims looking steady as well. But what happened in this month was nothing more than a drama. This month we saw a massive downward side in the NFP numbers. We only added 57,000 jobs, and previous job numbers were revised down as well. So now you have in total of two things. The number one thing which we have right now is the cooling of oil prices, and the second thing which we have is that the labor market is not so strong anymore. Now, obviously, at the very first point, the Federal Reserve was looking to hike the interest rates because of the elevated oil prices, as they were feeding directly into your inflation. But now, as the oil prices are moving down already, next week, as we just studied the correlation between oil and between the inflation rate, due to the declining oil prices, we can very well see a decline, a cooling of inflation going into the next week as well. This is your first thing. The second thing is obviously the labor market. The Fed will not hike the interest rates in an environment where labor market is very weak, where labor market is already softening and inflation is elevated. The Fed, maybe they can do an emergency hike, but they won't enter into a rate hike cycle. But right now you don't have a elevated inflation anymore, you don't have elevated oil prices anymore. The Fed does not have any reason anymore to hike the interest rates. Again, as we just studied the correlation, and as we just studied the reasons why the Federal Reserve was going to hike, those have totally reversed now. Oil prices are moving down. They should directly feed into your inflation, and inflation should move down as well. So the one reason which the Fed had to hike the interest rates is totally over now. And the second reason due to which the Fed was confident that yes, we can hike the interest rates was a strong labor market, which is not looking so strong anymore. All the reasons which the Fed had to hike the interest rates have now totally reversed with the MOU, with the cooling off in oil prices, with the NFP data which came out weak. And that is exactly why we expect gold to form a base here around the psychological area, around the strong demand area, and start its grind higher. But why? Why interest rate expectations will lead to gold moving higher? Now, as we discussed earlier, that gold is a non-interest yielding asset. It does not give you any benefit when the interest rates are rising. But as we just studied, that due to the decline in oil prices and due to the expected decline in inflation, we are not expecting rate hikes anymore. Due to that, the opportunity cost to hold gold becomes attractive to the investors, and that capital starts to flow out from the interest yielding asset toward a non-interest yielding asset during a lower rate scenario, during lower interest rate scenario, and that non-interest yielding asset is going to be called. Ask yourself that if the interest rates are not going to rise, and if your country already has massive debt, if you are expecting rate cuts and if you are expecting political uncertainty due to the midterm elections this year in the United States, then what is the best attractive asset for you to invest in? Is it going to be the dollar? Is it going to be the stocks? No, it's obviously going to be the only safe haven asset, which is gold. Investors will flow their money out of the interest yielding assets, they will flow their money out of the dollar, they will flow their money out of the bonds, and they will put their money into gold due to the fundamental picture, due to the macro picture which is being formed right now in front of our eyes. Now, the only missing piece of the puzzle of this lower interest rate scenario, of the repricing scenario, or of the scenario of the narrative in which gold is going to explode, the only piece of puzzle, the only last obstacle which is left is the inflation data which will be released next week. Now, if we see our economic calendar on the MRKT terminal, we can see for the CPI month over month, we are already expecting the banks and the general market forecast is already expecting a massive decline in inflation rate from the prior month. In the last month, the CPI month over month came at 0.5%, but now we are expecting a minus 0.1% reading. If you talk about the CPI year over year, it is the same scenario. Banks and the general markets are expecting a massive decline in the inflation rate. Now, these forecasts they already support our scenario. Now, just as a quick revision, that why gold prices are expected to explode going into the coming few weeks. Cooling oil prices, and due to that, we are expecting a decline in inflation, which should support rate cuts instead of rate hikes. Secondly, we have a softening labor market, which gives the Fed very little room to hike the interest rates even if needed. Also, we have the midterm election uncertainty coming up. Now, historically, from a seasonality perspective, midterm election years are the best performing years for gold prices because political uncertainty rises to its peak. And after that, from a sentimental or from a positioning perspective, banks and countries and institutions and hedge funds they continue to accumulate gold at these discounted prices. That is exactly why we are expecting, due to all of this macro picture being formed right in front of our eyes, we are expecting gold prices to explode. Now, the last thing which you need to focus on, especially going into the next week, is the inflation data. Is the inflation data really cooling off or not? Is the cooling oil prices really having an impact on the inflation or not? Because obviously, if the inflation data is still hot, which is very less likely, but obviously we are not saying anything for certain, we have to understand what the markets are showing us. If you still see that inflation data is hot, then in the short term it can still impact the gold prices and they can fail to break the around $4,200 psychological prices, but that is a very less likely expectation. The major expectation is a decline in the inflation prices due to the cooling oil prices, and due to that, as a result of that, we are expecting interest rate hike expectation to cool off as well, supporting gold prices and finally forming an uptrend in the very first way, targeting the around $4,500 psychological levels around the supply area. So this was pretty much it about all of this narrative. But one last thing which I wanted to tell you is that about our free signals. All you have to do is come to our website tradelog.net. I will drop its link in the description as well. You can scroll all the way down and here you should find a button which says that claim free signals access. For the past few weeks, we have been sharing all of our trades as free observation trades inside our public Telegram community until November 2026. You don't need to do any payment, you don't need to do or put any type of card details, payment details. All you have to do is click on this button and you will be redirected to our public Telegram community where all of our signals are given for you free with proper analysis and reasoning. This was pretty much it about the video and pretty much it about the analysis of gold. If you like the video, make sure you press the like button, subscribe button, and if you have any questions, you can ask in the comment section. I will drop all the relevant links in the description as well. Best of luck for the upcoming week.